Previously, I've made videos about a two-fund portfolio, which is very simple. It contains global stocks and global bonds. But in this video, we'll look at reasons why we might want to add a little bit more complexity to our portfolio and add a third fund. And we'll also look at the return implications of that choice and also the drawbacks. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and like this video. So let's look at the two-fund versus three-fund portfolio in a bit more detail. Let's begin by remembering why a two-fund portfolio makes sense. Because remember, you can have a one-fund portfolio that just contains a single multi-asset fund. And often these are risk graded, such as these life strategy funds beside me. These vary from 20% stocks up to 100% stocks in jumps of 20%. The remainder of the portfolio is invested in bonds, which have a lower return. So over the long term, as you might expect, the 100% portfolio, which is pure stocks, has outperformed all of the other portfolios. But the idea is that you'll notice that 100% stock portfolio is also very volatile. Over short periods of time, it crashes. And it crashed more, or at least it did, than a 20% stock portfolio, which is very much dominated by bonds. So for people who are being more cautious or investing over a shorter period of time, it would make sense to buy the less crashy version of the fund, which would be Life Strategy 20. So it turns out that you can actually mimic those returns very closely by simply having a two-fund portfolio. This is also cheaper in many cases than having one of those life strategy funds. So the fee for this strategy is often less than half of the fee for a life strategy fund. Again, what we're doing is varying the amount of stocks in the portfolio from 0% in this case up to 100%. And the effect is largely the same. Long-term returns increase, but the volatility and crashiness also increases as we add more stocks to the portfolio. So it seems like we've got a good solution. Why add complexity with a third fund? Well, in one word, 2022. What happened in 2022 was that interest rates increased hugely, both at the short end of the curve, but also at longer maturities. As a consequence, there was the biggest fall in bonds, government bonds, ever. This also happened at a very rapid rate. Previous sell-offs in bonds weren't quite as sharp or severe. So we went from a world of zero interest rates to one of normal interest rates over a very short space of time. As a consequence, what happened was that the funds which crashed the most were supposedly the safest ones. Here you can see that over the course of 2022, Life Strategy 20, which is dominated by bonds, fell by much more than Life Strategy 100. Furthermore, it's taking a long time to recover. Life Strategy 100 has already recovered its losses, whereas Life Strategy 20 is still floundering with losses of around 16%. And yes, our two-fund portfolio was similarly affected, with the 100% equity portfolio performing okay now, whereas the 100% bond portfolio is looking at losses of about 15% currently. How could it be that both stocks and bonds could fall at the same time? Well, the primary reason is high inflation. If we look at the price movements of stocks and bonds, usually what you see is that they move in opposite directions. When people are scared, they'll buy bonds. When people are feeling bullish, they'll buy stocks. This means that during a crash, you actually reduce the losses in your portfolio by having some bonds in that portfolio, high quality government bonds. However, high inflation is toxic both for bonds and for stocks if the inflation's high enough. And there was some really nice work done by Schroders, the asset manager, which looked at this relationship between inflation and the returns on stocks and bonds. What they showed is that during periods of high inflation, stocks and bonds correlate. They both fall together. In contrast, during periods of low inflation, they tend to move in opposite directions again. And in that case, bonds are a good hedge for equity. And of course, in 2022, inflation was very high and we saw stocks and bonds correlate and fall together. Consequently, a two-fund portfolio which just had stocks and bonds in it wouldn't have provided any shelter from the storm. The hedge wouldn't have worked. And ironically, if you'd have had a high-risk portfolio with lots of stocks in it, that would have been the safest place to be. So how can we add another fund to our portfolio to mitigate the chances of that kind of double fall happening in future? If you do want to keep up to date with macroeconomics and markets and how the two interact, then our free weekly market roundup is a great place to start. We publish it on a Friday. We won't send junk to your email, ever. And we also try to keep it entertaining. So here's one of the ones we had recently where I talked about bonds. And in fact, we got as many bond jokes as we could into the titles of the weekly. So it's entertaining, hopefully, as well as informative. So if you do want to receive that regularly, just look at the link below to find out more. Let's look at some candidates for that third fund. How can we shortlist those candidates? Well, one thing we could do, which is very simple, is to look at the returns in 2022 to see which funds would have provided some protection at least. And you can see a selection of funds with low fees beside me here and their returns over that crashy period. What's pretty clear is that if you went just for bonds, that would have been disastrous, or some single commodities like natural gas, but certain asset types did particularly well. So let's look at the survivors during 2022. Money market funds did very well. That's because this was a period of increasing monetary policy rates, things like the Fed funds rate, the Bank of England bank rate, all of those were increasing across the developed world. Consequently, money market funds, which pick up these short-term interest rate increases very quickly, benefited from those increases in short-term rates. Furthermore, money market funds are very safe. They're not very crashy at all. They're cash-like. And this is why I've been making lots of videos about money market funds. So that's definitely one of the survivors. One of the types of fund which did particularly well was a broad commodity index fund. These have exposure not just to one commodity, but a basket of commodities. Often they have quite a bit of oil exposure in them. And of course, one of the reasons why inflation was so high was rising energy prices. That certainly wasn't the only reason. There were also supply chain issues and an increasing demand for physical goods rather than services. But broad commodities would certainly also be on our list. Gold also did well. This is a commodity which people buy when they're scared. Unfortunately, it's also a commodity which loses value if the dollar's strong or if interest rates are high because it doesn't generate an income. So those two factors were weighing in the opposite direction, but certainly during this period in 2022, gold's value held up pretty well. Now finally, I've put this in brackets, quality stock funds, this is a factor approach to investing, and in particular USA quality as a factor, did very well. This avoided companies with too much leverage, for example, and also companies which had steadily growing earnings. And this combination of factors has performed fairly well. However, because these are stocks, I don't think they're a good hedge against the large stock allocation in your portfolio overall. So I'm not going to include that in our list. And just to get a feel for the crashiness of each of those investments, what I've shown here is the drawdown, the peak to trough fall from the previous all-time high for those candidates on our list. And I've also included global stocks and bonds for comparison. Now, stocks are notoriously crashy, and if we look at the fall in 2020, you can see that very clearly. Global bonds held up much better in the March 2020 crash, but of course they've crashed in 2022. The broad commodity ETF, which we're looking at here, is also very crashy, very volatile. But the key thing is that during periods of energy spikes, it's certainly going to mitigate losses in our portfolio if that leads to an inflation spike. The money market fund you can see here shows the benefit of money market funds, which is hardly any crashes at all. That's the whole idea of a money market fund. The price you pay for that is very low return for taking very little risk, although those returns are now quite respectable due to very high monetary policy rates. And finally, gold is quite crashy as well, just like any other commodity. It's also very volatile. Unfortunately, it has its own crashes. So as a hedge, I think I'd rather stick to a broad commodity basket than something like gold. And that's because it plays the double role of having some gold exposure, but also energy exposure. So given we've got our short list of potential third funds, now let's think about what allocations we might have to our three funds. Well, this is probably all reminding you of the all-weather portfolio, which I've also made videos about. This was created by Ray Dalio and his colleagues at Bridgewater Associates, which is a hedge fund, but it didn't fare particularly well during the latest sell-off in 2022. And that is largely because of the huge allocation to long-duration bonds. These make up 40% of the portfolio overall, and these bonds were completely crushed in 2022. and continue to lose value as I make this video. What did save the all-weather portfolio's bacon in this sell-off was the commodity exposure, both broad commodities and gold. But the government bonds didn't help at all. One thing I don't like about this portfolio is its very low stock allocation, which is only 30%. So overall, I don't like the very long duration in this fund, and I also don't like the fact that it's got very little stocks in it. So what would our 3-fund portfolio look like? Well, it really depends on your circumstances and your risk appetite. If you want more long-term return, you'd dial up the amount of equities in it, you'd increase the amount of your global stock fund relative to the other 2 allocations. In this example, I've shown 60% stocks, 20% commodities, and then a third bucket, which you can think of as the super safe bucket, which is either money market funds or single government bonds. Why single government bonds? Well, that way you can ensure that you're not going to take a huge loss if interest rates increase. That's because when you buy a single government bond, you know exactly what return you're going to get by simply holding that bond to maturity. And as we'll discuss in a moment, that might give you a little bit of flexibility according to where interest rates are. And in the safe bucket, you could also have a combination of money market funds and single government bonds. So really this is more of a framework than a specific allocation. But to show you that this would have worked in 2022, we can look at a 3-fund portfolio with developed market stocks. That would be our global stock fund. That would make up 60% of our portfolio. And we'd have 20% in broad commodities, that UC15 fund, and then finally 20% in a money market fund, which is CSH2. And you can see that yes, this 3-fund portfolio dodged that particular bullet. It didn't have much of a drawdown at all, and since the end of 2021 it's now up by around 8%, whereas a 100% stock portfolio is now just breaking even compared to the end of 2021. And our poor bond portfolio is still down by around 15%. But of course that portfolio did well in 2022 because we designed it to, and we chose assets which didn't lose value. As always, when you have safer investments as part of your portfolio alongside stocks, this reduces your long-term return. So if we extend our period of analysis all the way back to 2015, you can see that yes, we paid a penalty with the 3-fund portfolio. Its annualized return is only 9%, whereas if we'd have gone for 100% stocks, we'd have had 11.4%. So as is often the case, increased caution comes at the cost of reduced long-term return. And it always pays to remember those base rates, the average long-term returns for each asset type. Stocks are the real inflation-busting investments. So if we look at the Credit Suisse Global Returns Yearbook, this is from 2023. I guess this is soon going to be the UBS Global Returns Yearbook. That shows that stocks have beaten inflation by a huge 6.4% over the course of over a century. This is from 1900 to 2022. Bonds, on the other hand, have only beaten it by 1.7%. And short-term government bonds, or bills as they're called, have only beaten it by 0.4%. So if you are going to be investing for a long period of time, this is why it makes sense to put as much as you can into global stocks. They're the proven inflation-busting investment which has worked for a very long time. Now let's think about the variations of that portfolio and how that might be to our benefit. The most obvious variation is how much of your portfolio is in global stocks. Increasing that amount makes your stock portfolio more crashy over the short term and probably isn't suitable if you're investing for a short period of time, say 5 years or less. If you are going to be investing for a long period of time, more than 10 years say, then I'd increase the equity allocation because you can weather those storms without worrying about it. Stocks will almost certainly recover over a decade-long period. So if you are increasing the stock allocation, then you decrease your commodity and safe bucket allocation. So this is the primary lever in your portfolio, just as it was for the 2-fund portfolio. How much stocks, how much safe stuff. There's also flexibility in the safe components of the portfolio. If you think interest rates are rising, then it would make sense to put more money into the money market funds because those will pick up higher short-term interest rates as policy rates increase. Or if you're going to be buying just single bonds, you'd buy the ones with shorter duration. If you think interest rates are going to be falling, maybe inflation's come under control and there's word of policy rates starting to fall, Well, in that case, you'd want to lock in those high rates for longer, and you'd buy single bonds with longer times to maturity. Money market funds are going to pick up those lower rates very quickly, and you don't want to be stuck with those decreasing interest rates. So I think it does make sense to have that added complexity in your portfolio at the cost of perhaps reduced returns long term, simply because you could sleep better at night. But this 3-fund portfolio framework, I think, gives you the flexibility in the safe bucket, in the equity safe split, to have enough moving parts to be flexible, but just not too much complexity. I think the all-weather portfolio is a little bit too fussy, and its stock allocations too low, and its long duration bond fund allocations too high. Single government bonds offer you the ability not to suffer drawdowns, and I think that's really important too. Now don't forget, if you do enjoy our content, you'll love our weekly. People tell us it's entertaining and informative, and you can learn more about signing up for that by looking at the link in the description below. And, as always, thank you for listening.